this is a monthly chart of the S&P going back 25 years. It is rare that we have been this overbought. So the last 25 years, we've only been as overbought as we are right now, one, two, three, four, five, 6 times. Each time of those that we've been this overbought has led to a decent correction. This next correction, if it just reverts to its running bullish trend right now, is about a 26-27% correction. If it ultimately reverts to its long-term mean, that's a 60% correction. But this is why you have to be very careful with risk assets in this environment. Understanding the volatility risk in your portfolio is not just a function of, narratives and these type of things. It's about survivability. Most investors do not survive 50% drawdowns in markets.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back at the end of the week for another weekly market recap. In fact, a special holiday Christmas weekly market recap with my good friend, the Prudent Protector portfolio manager, Lance Roberts. How are you, Lance?
I'm doing good. It's you see, I've got my Christmas background
You
going.
look
It's
very Christmassy. Yeah.
that time of the year. So yeah, I love this time of year. It's
Well,
awesome.
and you're having a blue Christmas, it looks like, with your shirt and your blue background.
Well, actually, I tried red earlier, but it was a little bit too bright, so I had to tone it down a little bit. So I had to use blue. But yeah, the red
Hey,
one was actually had a Christmas tree and a bunch of other stuff. It was awesome, but it was just way too bright. So
like nothing wrong with channeling the king, right? Channeling Elvis on the holidays.
exactly.
All
Oh,
right, and look,
by the
oh, go
way,
ahead.
we have to start out this whole conversation this morning with the fact that I've been working on something for 18 years. 18 years. I talked about this on my radio show on Friday.
Yeah.
Sorry, on Thursday.
What is
But
this? Getting into your wife's good graces? What is it?
pretty close. Uh, actually, no, that's actually not what happened.
It's still a work in progress.
As is always the case. But for 18 years now, she and I have had an ongoing argument. And that argument is whether or not Die Hard is a Christmas movie.
Oh,
And I now have definitive proof that it is because just yesterday, Charter came out with this survey, Die Hard #5 on America's favorite Christmas movies. So my wife was traveling. She was in Indiana yesterday working on a contract, and so I texted her. This was about 6 o'clock in the morning, so it was about 5 o'clock her time. So I text her with this chart that says, "Ha! I win this argument. No debate. It's over with." And she goes, "That's not even really a survey."
Oh man, that's great. Well, look, you count me in the camp that Die Hard is indeed a Christmas movie. I'm going to share something since you brought that up. Let's see, this is on X here, so let me see if I can pull this up. So I shared one of my favorite Christmas ornaments on X, and I don't know if folks can see this well. This is a jar of marshmallow fluff. And I think knowledge of fluff may be fairly regional, but fluff is a marshmallow spread that you spread on a slice of bread. It'll give you instant diabetes. But where I grew up, you would make fluffernutters. So you'd take marshmallow fluff, you'd slather it on one side of the bread, you'd put your Jif or Skippy on the other, you'd slap them together, and you'd have a fluffernutter. They make fluff. It's, I'm probably going to get slaughtered by the folks that know this. I want to say maybe it's in Lynn, Mass, but somewhere in north of Boston, which is where I grew up. So it was very much a local delicacy where I grew up. So I shared this image on X, and yeah, some of the folks that had also good memories of fluff chimed in. But one guy, oh, there it is. That's what I was looking for. One guy chimed in and said, "Well, this is my favorite Christmas tree ornament." Can you see that, Lance?
That's awesome.
John
Yeah,
McClane crawling through the duct and from Die
yes,
Hard.
absolutely. And by the way, you're right. Marshmallow Fluff is made in Lynn, Massachusetts, at the original factory that is owned by Durkee Maurer, which has
Yeah,
been
pardon me?
in existence since 1920.
Yeah, it's been around for a long time. I just got an update from my stepmother when I shared that ornament with my family that apparently she and my dad knew the actual guy that created Fluff, and believe it or not, there there was there were flufferettes. I don't know exactly what they did, but they were part of the marketing and promotion, I think. So when I heard that term, I was like, I definitely got to steal that. All right. Anyways, folks didn't expect us to go in this direction. We got a lot to talk about. I do want to leave some time for the rant today. I think, an important one to have. I'm just going to apologize in advance, Lance. I don't know if you can hear the gale that is raging outside of my office here. But here in Reno, I've been learning that every couple of weeks we get these, I mean, real gale force winds, like over 100 miles an hour. It's not raging that badly right now. I'd probably peg this at around 50 or 60. They call it the Reno Zephyr, and I'm thinking, well, isn't the Zephyr supposed to be like a gentle breeze? I mean, this is more like, I don't know. It's like an aspiring hurricane here. So, anyways, tell me if it interrupts the audio at all. But sounds like it's not getting in the way yet.
Yeah, I can't hear anything.
Okay. All right. Well, look, this has kind of been a willy won't he story over the past couple of weeks of, is the Santa Claus rally going to arrive? You recently put out a piece that said, markets were oversold after a key break. They've been consolidating after testing the 50 daily moving average. So are you still thinking it's more likely here that Santa is going to show up on Wall Street in this last week?
Well, again, this is, the whole issue with the Santa Claus rallies, you're playing statistics, right?
Mm-hmm.
So statistically speaking, Santa tends to show up on the last 5 trading days of the year, which will be just after Christmas. And there's an old saying on Wall Street, which is, if Santa comes to Broad and Wall, then that's great, right? If not, then not so much for next year. So, one of the big questions is that, as we go into the end of the year, it's portfolio window dressing, those type of things. And so we have had a good bit of weakness here in the first couple of weeks of December. You'll remember back in November, we said, hey, be aware the first couple of weeks of December tends to be a bit sloppy. You have mutual fund distributions, those type of things. And it looks like we're mostly through all of that. Now, today, as we're speaking this morning, it's about 10:20 Central Standard Time. So markets are trading this morning, but this is one of the largest options expiration Fridays in history. So again, what we talk about this morning and how we end up today could be two very different things. But right now, we did come down. We tested the 50-day moving average. Retail investors stepped in yesterday, bought the dip as on Thursday, got us back above the 50-day moving average. And today markets are trading a bit higher. So that's all kind of positive because we're kind of came down, tested support, bounced off support. That's good news. And then next week, it's inmates running the asylum for the next 2 weeks. Professional traders are all gone. They're at their mansions in the Hamptons right now, or out in California and Palo Verde or wherever that they go to in California. But yeah, they're gone for the next 2 weeks. So it's going to be pretty much retail traders driving the markets through the end of the year. And we'll have a little bit of window dressing in the year end. So the bias right now, statistically speaking, is to the upside, but again, doesn't guarantee it has to happen. Now, a little bit about statistics. The last 15 days of December tend to average about a 1.4% rate of return in total on average. So some years better, some years worse. Historically speaking, it is rare, like it's only happened once, that you had 2 negative Decembers in a row. We had a negative December last year. So statistically speaking, the odds are that this month will end on a positive note. Now, that doesn't mean it's going to be up 5%. If it's up 1/10 of 1% at the end of this year, or at the end of this month, it was a positive month, right?
It's still up, yeah.
Yeah. So be careful, be careful with exuberance, those type of things. The market's been trading a bit sloppy over the last couple of weeks. We're seeing some definite rotation within the market. Staples have been performing very well. Transports have performed well. We've seen a lot of the previous leaders. Technology, which was extremely overbought going into October, has reversed a lot of that rotational bias and is now decently oversold. So, we've seen that rotation in the market. Breadth has improved. If you take a look at, one thing we kind of look at is just the difference in performance between the S&P 500 market cap weighted index and the equal weighted
Equal weight.
index. And that equal weighted index on a performance basis has started to, and there's still a big gap for this year. Market cap's leading the way this year, but that gap has closed a bit, which suggests that there's a bit of rotational broadening within the overall markets. Of course, we've seen stocks like Costco and other kind of Eli Lilly and healthcare related stocks, financials. They've all picked up in performance over the last couple of weeks while tech's been under some pressure. But that should have been expected after the run that we've had.
Yeah. It's interesting. I wonder about the breadth indicator, whether it really matters that much anymore. We've had terrible breadth in the market for a lot of the past couple of years, and it hasn't mattered, right? As the Mag 7, Mag 10, whatever you want to call it, has powered everything higher.
Right.
Technically, seeing this rotation, the sector rotation, seeing this increase in breadth should be a healthy sign and make you positive. I just don't know if it's as correlated as much anymore with market performance as it used to be. In other words,
Well,
we could get better breadth, but a worse overall market performance.
no, it's very possible. And again, we've talked about the whole passive indexing effect, and that certainly benefits those big 10 stocks for sure. Um, you know, should you disregard breadth out of hand? There's a lot of indicators that seem to have broken, right? The CNN Fear Greed Index is a good one. That's been pointing at fear and extreme fear, and the market's been rallying,
Right.
higher.
The
So
leading indicators haven't mattered forever, right?
exactly. So, but a lot of this distortion has been caused by all the stuff that happened post the pandemic, where we just flooded the system. And again, you just take a look at retail trading activity. It's exploded since 2020. It was a very minor factor in the market, and it just went parabolic in 2021. And they're buying ETFs. I just was posting a piece this morning. The number of levered ETFs that people are buying, the volume of purchases in levered long ETFs outpaces inverse ETFs by 12 and a half times. So investors are just piling into these levered ETFs to gain leverage in the markets. And again, those are all feeding the same stocks, right? Because they all own Apple, they all own Google, Meta, whatever. So this is one of the reasons you can kind of continue to see this this divergence within market breadth, because again, when I throw $1 into the index, 40 cents of it's going into 10 stocks. ExxonMobil's over there in the far left-hand corner scrambling to get, a penny out of that dollar, right?
That guy can't get a date. Yep.
Yeah, exactly. And same thing for Procter and Gamble and Coke and these other companies. They just don't get the flow because you got 493 stocks quibbling over 60 cents out of every dollar. So, they're just getting a fractional, taste of those inflows that are happening into these ETFs. We've had 1,000 ETFs issued this year alone.
So I think I heard this stat, and you tell me if you know it's right or wrong. But not that long ago, I think I heard that we had more ETFs than we had individual
Okay,
stocks, individual companies to invest in, right?
that's
So how
correct.
long do you think it's going to be before we have more levered ETFs than we have individual companies?
At the rate we're going, not long. And again, thank goodness.
And sorry, and that's not to mention margin debt on top of these levered ETFs, right?
Yeah, and the thing about that is that people are buying levered ETFs on margin, right? So you're just adding leverage on top of leverage. But look, thank goodness.
What if you're buying a call option on a levered ETF with margin?
This kind of reminds me a lot of what we were talking about during the, heading up into the financial crisis. We were talking about derivative trading, and it was the weapons of mass destruction. If there was
Yeah.
ever a derivative blow up, it was going to be massive. And we saw what happened. We're seeing the same thing in the market. And again, look, let's be really clear about margin debt. When you see margin debt rising, that is very bullish because margin debt increases buying power in the market, which drives markets higher. So as long as margin debt keeps increasing, that's bullish for the markets. Now you look at that numbers like, oh my gosh, margin debt's at an all-time record. I just did an article recently talking about margin debt as a function of disposable personal incomes, all-time record, right? Um, but as long as people are willing to keep buying that on margin and keep pushing it up and prices keep going up, it's all fine. But the edge that cuts you with margin debt is the edge that cuts the deepest. And that's when the market reverses and you have to have this forced selling of assets. So The problem comes is that when you get a downturn in the markets, in fact, I just posted an article this past weekend in the newsletter talking about the Bank of International Settlements. They just did a whole study on the double bubble, which is the bubble in
Right.
stocks and gold. And I overlaid some charts of gold, silver, and stocks on margin debt. And they are very highly correlated because again, that's where when people are looking to leverage and chase performance, they lever and chase whatever's going up. There's a very high correlation between the rate of change in margin debt and the rate of change in these other assets, which not surprising, right? It's all speculation. So the takeaway from that is when that reverses and margin gets called, those same assets that were tracking it on the way up will also track that margin debt on the way down because liquidity is being extracted from the market and you have to sell something to cover. So, and again, remember about margin debt, the most important thing is closing margin debt is not at your option. When the margin call comes, the bank calls you up and says, you need to close out your margin debt today. So either you need to deposit cash or sell something. And if you don't sell something by close of business, they will sell it for you
They will
indiscriminately.
sell it for you. Yeah.
So, that's the risk that, if there's something, again, this can go on for a long time, right? Don't think just because margin debt's elevated right now that that means the markets are going to crash tomorrow. That's not what that means at all. It could be a year, it could be 2 years, it could be 3 years. We saw similar levels of this back in 1997, and it was 2 more years before the market blew up. So, don't mistake current levels of margin debt because those current levels of margin debt are very bullish for stocks and Bitcoin and gold and you name it. Whatever's growing up in price, people are buying on margin because they're out of cash. I've bought all the stocks I could buy. I don't have any disposable personal income left. So I've got to go on margin to buy more because markets are going up and they're never going down again, according to the media narrative. So you get the speculative chase, but when that reverses, that margin becomes the fuel for that reversal as well.
Yeah, yeah, and so you're right. It's bullish in the foreseeable near term, but then you have you know, I'm hesitant to use the word inevitable, but it usually is, right?
No, it's
The inevitable reckoning. I mean, you can jam as much amphetamine, keep jamming amphetamines into the racehorse, and it'll run faster and faster right up until its heart explodes, right? That's
no, look, and look, let's be really clear. All asset classes are going to mean revert at some point, right? That is the most powerful force in investing throughout history. What goes up will come down, and what's gone down will go back up. That's how markets work. So again, but the problem is that as we talked about before, there's people running around going, "Oh, the markets are going to crash in 2026. You're going to lose 50% of your money, or they're going to crash in 2025 and markets will be down by 25, 50%, whatever." And it didn't happen. So the problem is always is the timing of the
the
outcome.
timing. Yeah.
Is it going to happen? Absolutely. Right? 5 year forward from current valuations, 5 year forward returns are zero. Right? So we know that that's a function of math.
Right. And many say
Problem is the
10
time.
years using math as well. 10-year expected returns are zero still. Yeah,
Yeah,
or
yeah,
better.
absolutely. 20 years are like 2%. So, the forward return expectations from current valuations is not great for investors. Now, does that mean that every year is going to be a 2% return over the next 20 years? No, that's not what that means. It means that there's going to be some significant corrections along the way. And you'll look back over 20 years and go, wow, I made 2% of my money. And that holds true for all asset classes. So, that's the thing that we have to be aware of. But again, the timing is the hard part. We're so wrapped up into immediacy that, it's like every day we flip on our screens and the lights are red or green or whatever. And it's like a dopamine effect. And so we're all focused on this day-to-day action in the markets. And we forget that over the long term is what matters. And surviving the game is going to be the real hard part for most investors. And history proves that out as well. 30-year returns for most investors is very poor.
Um, all right. So, the I get your perennial warning, which is a good one to keep delivering, which is yes, there are things like crazy amounts of margin and leverage in the system, but they're bad timing indicators, right? They give you a good measure of the degree of risk. They just don't tell you when that risk is going to matter. And one of the things complementary to your warning I like to remind people of is the whole system wants the status quo to continue,
Mhm.
right? Wall Street wants the status quo to continue. They want prices to go up because they can sell more stuff and make more profit. And the investors themselves want prices to go up, right? So
And
right now, pardon me?
The Fed wants prices to
And
go
the
up.
Fed want, right.
Financial stability.
So my point is there's kind of intervention from every which way here, right? You've got intervention from the Fed and the central planners. They've been goosing the markets, I mean, the system a ton over the past bunch of years, as we've talked about. They're continuing to. We have this not QE, which is really QE going on now again, right? You have Wall Street that's trying to keep the party going because they keep introducing new ways to bring leverage into the system, all these new levered ETFs you were just talking about, right? And then you have the retail investors themselves saying, yeah, I want this to continue and I'm going to lever up to keep this party going, right?
Yep.
So this is sort of the, don't stand in front of the juggernaut if you don't know exactly when the juggernaut's going to end, because if not, it's just going to flatten you, right? So it's wise to be prudent. It's wise to be cautious. You should definitely have a plan for the thing rolling over. You should have hedges. I like to say a lot about, for what could roll over. You want to have your perennial protections that you talk about, Lance, diversification, harvesting your gains in case things reverse faster than you think, right? There's all that stuff in there. But this thing could go on a lot more than you think. The whole thing about the market can be irrational longer you can remain solvent. So we just got to
Yeah.
be cautious. Now, that said, you were talking about statistics and you said that rare to have two back-to-back Decembers, right? And we'll find
Right.
out if we have one this year or not. Um, and by the way, we're up for December right now from the start, correct? Like if the month ended today,
You
would
were
we be
saying
up?
that. Yeah, you were just saying that. And I was like, I better go check, see where we are as of today. Give me just 1 second. I just got to pull
Okay.
the
Well,
chart.
while you're checking it, I'm going to ask my bigger question, which is, I am worried statistically about the markets. I mean, I've got a lot of other worries as we have talked about and we will talk about, but statistically, I'm worried that you almost never get four great back-to-back years in the market. Because as you said, markets mean revert. Now, they've been distorted a lot, but especially by the unprecedented amount of intervention that COVID brought on here. But at some point, that juice will finally run out of the system. And I worry that the reversion to the mean could be a hell of a reversion because we've had already three, potentially 20 plus years back to back to back. It's highly unlikely we're going to get a fourth one. But could we? Yeah, absolutely. Which is
Absolutely.
why don't go hide in a hole right now. Yeah.
Yeah, no, yes, the market is still positive for the month of December. So
Okay. So it would need to actually fall from here to get us to negative. Yeah.
but no, you're absolutely right. We've had 3 fantastic years. We're probably going to end up somewhere around 17% positive for the year, give or take a little bit, plus your dividends,
Yep.
1.8 or like almost 19%. It's not a bad return year. The problem is that we've gotten so used to those returns that, I'm seeing a lot of stuff running around lately is like, oh, 60/40 allocation's dead. You don't want to own that. And you want to own all these risk assets, which, that's all fine and dandy until the mean reversion occurs. And then you're going to be glad you had something that will preserve your capital. But, like our bond portfolio this year is up 6.67% on a total return basis and for no risk. It's all treasuries, right? So you know I don't have to stretch a lot to create a return in my portfolio with no risk. And then I add in some growth stocks, which our
Yeah.
portfolio is up with the market this year. It's trading about 17% higher this year. Throw in it's got a dividend yield of probably 1.5% ish, give or take. So you throw that on top of it, that's not a bad return for the year. Certainly gets me towards my goal with a lot less volatility. And then, if you're right, and which you will be at some point, now whether 2026 is the year or 2027 is the year, we're going to get some type of mean reverting event in these assets because we have the big risk we have right now in the market. We have too many asset classes that are correlated, right? So we have too many asset classes that are trading with a near correlation of one. And the problem with that is that makes the market very fragile because you have nowhere to go when the market sells off. Because
Right.
when the market starts to sell off, everything that's correlated has a correlation of one. Money's got to go somewhere, so it's going to look for a non-correlated class, and unfortunately, there's not many, and that typically leads to much larger corrections in the markets.
Yeah. Okay. Hey, real quick, just because you said it, it's stuck in my head now. Help walk me through the math. How do you get a 6.5% return on U.S. Treasuries because I don't think any U.S. Treasury was yielding that much.
No, this is total return, right? So you have price appreciation. Remember, we shortened all of our duration. So we bought, when the Fed started cutting rates, we bought a lot of short duration bonds. So they've gone up in price plus the dividend yield on the interest income on those. So our total return this year, so far year to date, is like 6.63, 6.67. I haven't checked in a couple of days, but just it's about duration management. See, too many people focus on the 10-year treasury rate.
Right.
There's a lot.
I guess I just forgotten. So where were yields at the start of the year? Were they closer to 5 or something like that? Is that why? Okay.
So yields have come down. Yields have come down 10-year treasury as well. So again, so that gives you some price appreciation. And
Okay.
again,
That makes sense.
it doesn't take much. And, I try to lay this out for people often. It's like, I don't want to own bonds because they're only yielding 4%. I can get 15% in the markets. Yeah, you can. The great thing about a bond portfolio is, say you take if you do some basic analysis of whatever your financial future looks like, depending on your age, you say, look, I want to have $1 million in the bank by the time I retire. So you do the math backwards, say, this is where I am today. How much growth do I need to go to $1 million by the time I retire? Say it's 6%, right? So you cut a portfolio in half and you put 50% in bonds yielding 4% right now. That's 2% of your return. That's 2% of six already. You've already got 1/3 of your work done, and you have an absolute guarantee of return of that principal in the future.
Right. Right.
So you got no risk to that. So now on the other side, I put another 50% in stocks, and I just buy the S&P index. We'll keep it super simple. So now I get 2% dividend. I'm rounding numbers here, so
Yep.
just for math, I get a 2% dividend yield on the S&P. So that's another 1% total return to my portfolio. So now I've already got 3 of my 6. So 50% of my work is done between bonds and the S&P index. That means I only need a 3% return out of equities to get to my goal. And so if I get more, great, fantastic, right? If I get 10% on that side, that's an additional 5. So now I'm doing well above my target. But I've got a very low risk adjusted portfolio to get to my retirement. And if the market completely falls apart, that's great because stocks will go down. I can reduce my stock exposure. My bonds are going to still mature at face value. So I've got no risk there. So I can ensure my path to retirement without a lot of work. And I really don't need to guess a lot at the markets and worry about these big major, we're so worried about this massive correction in the markets, but it's fairly easy to navigate for it just by doing a decent allocation process.
Okay. Oh, that totally makes sense. Okay.
But here,
Um,
I was gonna show you this because to your point, I was just bringing up a chart here real quick. Let me change,
okay.
let me smooth this out.
I was also just going to say too, given the math you laid out there too, yeah, the bonds are just chugging away, and you're guaranteed the return of principal with the yield that the bond is promising you. But if it's an environment, say like the past 40 years, where bond yields are coming down, well, you'll also get some appreciation there too, which can
Yeah.
speed that half a long way. Personally, I think it's less likely to have that tailwind over the next couple of decades like we've had, because I think the bond market
Well, well, look, we had a wonderful from 1980 to 2008. It was magic, right? I bought stocks. I got a great return out of stocks. I bought bonds. Bonds were going from a 14% yield to 4 in 2008. So you had this massive tailwind for price appreciation, right? You're not going to get price appreciation. I mean, you're at 4% yield right now. If the world normalizes around 2%, you're going to go from 4% to 2% on yields ish, give or take, and excluding
yep.
recession. But there's just not that much upside in bonds from here because you're already at fairly low interest rates. So, but that's not, you don't buy bonds for capital appreciation. This is the mistake that everybody makes. Like, oh, I've got to buy bonds. I've got to have capital appreciation. No, no, you don't buy bonds for capital appreciation. You buy bonds for
For
capital
income.
preservation and income.
Yeah.
And we talked about this before. This is when you're building a portfolio. If you take nothing else away from today's conversation, take this away. There are 3 factors to your portfolio, which is liquidity, safety, and return. You can only have 2 of those 3 things at any given time, right? So I buy bonds, I have safety and return, right? Because my bonds will mature at face value and I get an interest income. If I buy stocks, I have liquidity and return, but I have no safety. If I buy gold, I have liquidity and return, but I have no safety, right? So in every asset class, annuities, bonds, whatever it is, every asset class, you can only have 2 of those 3 functions. So when you build your portfolio, I want to build a portfolio that can provide me safety, liquidity, and return. And so that's how you have to blend your asset structure. And so you never put a risk asset in your safe bucket. So you would never, so if you're building a 60-40 allocation, everything that goes in your risk side of your equation, right? That's your equities, your gold, your silver, any Bitcoin, those are all in your risk bucket because those can lose tremendous amounts of value. Historically, they have. In my safety side, that's your annuities, that's your bonds, that's your real estate, physical real estate, not REITs. REITs belong in the risk bucket because they go up and down in price. But your fiscal real estate, your annuities, anything that has a return of principal function on it, or has some guarantee of value, like a piece of land isn't going to zero. It could go down in price depending on when you sell it, but it's going to be pretty stable over time. But those kind of all go in your safety bucket. So if you think about your portfolio between safety and risk, now you can create a model that gives you safety, liquidity, and return over time. It can guarantee that you'll survive the long-term outcome of the market.
All right, I get all that, Lance, and I agree with all the logic and everything. I'm going to ask this question against my better judgment here, but uh, why would you not put gold in the safe bucket? And look, I understand that gold is a volatile asset,
Mhm.
but some would say it's like a piece of land, right? It's not going to go to zero. It doesn't pay you an income stream, but it is considered much more of a risk-off asset than a risk-on asset. I know correlations are to one right now amongst a lot of asset classes. So in the immediate term, I can kind of understand that. But why would you consider gold in the risk pile, not the risk-off pile?
Because it has volatility risk to it. So in other words, here's a long-term chart on gold. And it spent, like, for instance, in 1987-ish, whatever, it hit its peak and it went 50% lower over the next 15 years. So that's not an asset that is either outpacing inflation, protecting the preservation power of my purchasing, or helping my assets grow. So again, you have these spurts and commodities where they do very well, but gold is a good example of a volatility asset when it's extremely overbought. And by the way, it's more overbought now than ever in history. And a correction back to its mean right now would be nearly 50%. Most investors will not survive that correction. And what I mean by that is they'll panic and sell it, right? So
Hmm.
they'll destroy the value of their money. Yeah, if I was committed to saying, look, I'm going to buy gold here and I'm never going to sell it ever. Doesn't matter what happens in the markets or anything else, I'm going to hold it. You'll probably be okay. But the problem is for a lot of individuals, let's say I was 55. Here, let's pick a better date. So here's 2012. We hit a peak in this. Gold fell by 50%. It took, almost 10 years really to get back to even. But if I was 55 at that time, I spent 10 years making no return on that money. So whatever that portion of the money that was supposed to grow from my retirement didn't. It didn't outperform inflation. I took a principal loss on that calculation during that period of time. Now I'm 65 and I've impaired my return profile. So I need
Okay.
to manage. So when I buy or when I so let's back this up for a second. Any asset that has volatility risk to it has to be in the risk bucket. Because if it declines by 30, 40, 50%, it destroys the whole reason why I'm trying to control. So it has to be an asset that I control the risk of by taking profits, hedging, rebalancing, reducing risk, all those type of things. I have to be able to do that. On my bond side, my annuity, like if I own an annuity in my safe bucket, I can't do anything with that. I can't go sell the annuity. I take massive penalties, those type of things. And annuities there to pay a guaranteed income stream in the future. I buy a bond, it matures at first full face value. I don't have to worry about principal risk ever inside of a government bond, and it's going to throw off a yield every single year. The risk to the safety bucket is that it doesn't adjust for purchasing power parity.
Right.
In other words, my 4% yield in my bonds will be 4% every year for the next 10 years. So what do I need in my risk bucket? I need gold, I need stocks, I need Bitcoin in my risk bucket to go up faster than the rate of inflation to ensure that my safe bucket is adjusting for purchasing power parity in the future.
Okay. That makes a ton of sense. I might suggest that you take your raw land and take it out of the risk-free bucket. But other than that, that
Well,
makes total sense to me.
normally for when I'm talking about real estate, the reason that's in the safe bucket, that's normally people's primary residence.
Okay. Well, that makes sense. You got to have a roof over your head.
I have a place to live, right?
Yeah.
But I was going to show you this too. We were talking about the S&P a second ago. This is a monthly chart of the S&P going back 25 years. It is rare that we have been this overbought. So the last 25 years, we've only been as overbought as we are right now, 1, 2, 3, 4, 5, 6 times. Each time of those that we've been this overbought has led to a decent correction. You can barely tell some of these, right? So this correction back here, this is the financial crisis. Looks like a little dip now, right? No big deal. These were 20% corrections in here. This was a 35% correction here. This was about a 25% correction here. This next correction, if it just reverts to its running bullish trend right now, is about a 26, 27% correction. If it ultimately reverts to its long-term mean, that's a 60% correction. That would still be in a bull market, mind you, right? We've talked about this before.
Yeah.
But this is why you have to be very careful with risk assets in this environment. Understanding the volatility risk in your portfolio is not just a function of narratives and these type of things. It's about survivability. Most investors do not survive 50% drawdowns in markets. They wind up panic selling, getting out of the markets, doing everything wrong. That's what investors do over time. Yes, are there individuals that can just weather that? No big deal. Yes, there are people that can do that, but they are a very rare commodity that have that type of emotional stability to work through a 50% correction.
And this is why and I think are nervous about this whole reversion to the mean threat of, we've had 3 great years in the immediate past, but also markets rarely been this overvalued, as you've said, right? And there's a lot of things out there that suggest that a wicked reversion to the mean is probable. Not guaranteed, but probable. The problem, as you always say, is we just don't know when, right? So,
Yep.
okay. All right. Well, look, since we're looking at charts, could you bring up just the latest S&P chart? Let's look at where we are heading into the last week of the year here from a technical standpoint.
Hold on a second. I'm checking my dates here because you said last week of the year. So actually, we got a week and a half. But just because I had to double check that because I was like, man, are we already there? Yeah, but here is the latest S&P chart. So again, here, let me zoom in here just a little bit so you can kind of see this just a bit. So this was we had a 4-day sell-off coming into Thursday and Friday. And again, mind you, we're currently trading. It's now about 10:45 Central Time in Houston. So markets are still very early in the day. The good news is we came down. Last week I produced this chart for the newsletter and laid out the various short-term kind of support and resistance levels for the markets. And that's these lines are. So we have support at the 100-day moving average, which is orange line, critical support at these bottoms going back to the correction we had back in October, and then critical support at the 200-day moving average. So these are kind of your big support levels you want to pay attention to. So we had this 4-day sell-off. We came down. We actually broke the 50-day moving average for a day. Now, this is something we talk about a lot in our shop, is that just because this is where investors also make a mistake. They go, well, I've got to stop. I'm going to set my stop at the 50-day moving average. If I break that, I'm out. And so they break the 50-day moving average. They sell their positions. They feel good about themselves. Like, see, my stop work got me out of the market just in the nick of time. And then the market turns right around and goes right back up the next day. And they're like, oh, damn it. So this is why when you run a stop loss in your portfolio, always give it some time, right? So set your 50-day moving average. That's your stop. And then give it some time. I always give it through the end of trading on Friday. If the market breaks the moving average on Tuesday, I give it till Friday. If it breaks it on Thursday, I give it till Friday.
All right, sorry to interject, but just make sure folks are understanding. So instead of setting an automatic stop loss that says when it hits this price, sell me out, have it be more like an alert where it says, okay, it's triggered the level you were worried about. Now you're saying watch it closely from here, but don't necessarily sell it immediately.
And here's why. You should never use automated stop losses in your portfolio, ever. And the reason is that when you enter that stop loss into your trading system, let's say you trade at Schwab or Fidelity, and you say, okay, I'm going to put a stop loss on Apple at $50 a share, whatever the number is. And so you put that order in. It says, if the stock violates $50 a share, sell all my shares. All the algorithms are out there and they're watching these live stop orders. So when you put your orders in, they start hunting you. And you can see this in the chart. There was a bunch of stop orders sitting out there at the 50-day moving average. And you can start seeing the algorithms hunt that moving average. So they start putting in sell orders and they start driving the price lower. And as soon as it triggers all those stops, and this is why you see this a lot within the markets. We hit certain support levels and the market immediately turns around. That's because those algorithms were hunting those stops. And as soon as they trigger them, they start buying the stock on the other side. And that's why the stock rebounds very quickly and goes back up. So never use an automated stop loss order in your portfolio management. We have a whole system that we built internally in our office that we place our stop orders and it sends us an email immediately when that stop order is done and tells us, okay, that stop got hit. And then we can go in and evaluate what's the market doing now. Are we seeing buyers show up? Are we seeing those algorithms start to step in and buy? Or are we starting to see volume pick up on the sell side? So that helps us navigate that. But yeah, you should never, because of all the computers that are out there, Citadel Securities, everybody else, especially on Citadel Security preys on Robinhood traders. If you trade on Robinhood, you're getting preyed on by Citadel because they're watching all your trading activity and they're trading ahead of you. And that's how Citadel makes
Yeah.
billions of dollars every year by taking advantage of you. Free trading is not free, by the way. You pay for that. But yeah, so when you're managing it, I would build some type of if you're using trading software, like an E-Trade or something like Think and Swim or what's the other one, e-Signal. You have the ability to place alerts within your system and just have it alert you. Says, hey, this price was hit, send you an alert, but don't actually execute the order.
Okay, yeah. So you're absolutely correct. There's an arms race out there that you are not the big dog in, and these guys will push you. If you're just using automated stops, they'll push you to the point where you trigger your sell, and that's engineering for them an artificially low buy price, and they buy it, and then the stock bounces back up. Let me ask you this, Lance, because I don't know the answer to this. Do these quant shops with all the algos and everything, can they actually see the stack? Can they actually see where these uh,
Yeah.
trigger orders are set?
Absolutely. Yeah. When a live order is placed into the system, that is viewable by everybody. So if you have level one, level two, level three data, yeah, you could see where all the sell orders or buy orders and sell orders are all stacked up. And at certain prices, there's so many, so much volume here to buy, so much volume here to sell, et cetera. Absolutely, they can see that
Wow.
data.
So that's almost like being at a poker table where you can see the hands of the folks around you.
Yeah, yeah. Basically, you're playing poker with your cards facing your opponent.
Yeah. Yeah. I mean, that's really important to know. Yeah.
Yeah.
Yeah. And look, I mean, I think intellectually the concept of a stop is really prudent, right? Hey, I want to make sure I don't lose more than X on this company. I think it's worth Y. If it drops far enough below that, I want to get out. But now you got to really think about, well, if I'm using a stop, am I just kind of guaranteeing I'm going to be selling the stock for less than it's trading for now because these other guys can see my cards and push me out?
Yeah.
So it's something to consider.
Yeah, no, and there's a couple of things you can do to combat this. If you want to use automated orders, there's a couple of things you can do. First is don't use standard measures. And what I mean by that is like, for instance, everybody uses the 50 and the 200-day moving average. That's very widely used within the market. So everybody steps when they set their stops, they set them at the 50-day, at the 200-day. So there's all these orders that are stacked up at those levels. Use an oddball data. So we use some moving averages in our shop that are odd. Instead of for instance, if everybody's using a 12-week moving average, use a 14-week or a 13-week or a 15-week. Use something that most people aren't using,
Mhm.
and use that as trick because again, if all the algorithms are set to look, for instance, at the 50-day moving average, and we break through that, and let's say I put in a 63-day moving average, I'm just picking a number,
Yep.
63-day moving average, and put below that, you'll see where, that tends to be a little bit better buying support in a lot of cases because you'll see it break like we saw in the 50-day, and then the markets will kind of bounce off whatever's right below that because that's where all the buying's showing up. So if you break through that kind of oddball number, now you've got a little bit better picture about what's happening in the markets. And if there's more selling coming, et cetera, you're going to kind of rip through these kind of oddball levels. That's just kind of one way to try to offset some of that volume risk that occurs at these levels where everybody's watching the same number.
Okay. All right. Well, look, good lesson. Let's get back to what exactly the markets are doing right now. I think I diverted you from that.
Well, no, so yeah, so right
Important
now,
point to make, though. I'm glad we made it.
yeah, yeah. Right now, the market is back above the 50 and the 20-day moving average. As of this morning, again, how we finished today. Today's a huge options expiration day. Market's going to be all over the place today. So just, it's going to be hard to tell. As long as we hold the 50-day through today, that's probably going to be fairly bullish. We've turned relative strength back up. We kind of worked off some of the overbought condition we had. And so we're kind of turning back up here on a relative strength basis. We had triggered a little bit of a MACD momentum signal. That's starting to turn up here. So if we get some follow through, Monday, Tuesday next week before we actually hit the holiday, and remember, next week it's all inmates running the asylum.
Yeah.
Retail buyers kind of push this market up a bit. We kind of trigger a bit of a buy signal. That's a really good setup for that last 3-4 days of the year for that window dressing to occur.
Okay. And the institutional traders and stuff, they're gone now through the year, right? They're not coming
They,
back enough.
no, they probably left 2 days ago.
Okay. Okay.
So, yeah.
All right. So it truly will be retail driving the action from now until January.
Yeah. And so there's going to be some good trading opportunities. There's some stocks that have just gotten the dog snot beat out of them. Companies like Oklo and Applied Digital Corporation, others, they've really gotten beat down hard over the last really kind of month. And there's still a lot of those are still kind of some of the retail kind of mania favorites. And so there's going to
Mhm.
be some stocks that are going to move, 15-20% from current levels into year end, just as people try to get those on their books. I'm not
Are
saying go
any
buy those. I'm not saying go buy those. I'm not saying go and say buy Applied Digital or Oklo. I'm just those are retail favorites that have like Oklo lost like 50% of its value over the last couple of months. So there's going to be some tradable. If you're a trader and can trade technicals, there's going to be some decent little trading setups for 2 or 3 days.
okay? Are any of those darlings on your target list right now, or is that just
No, we're positioned. We're already positioned for year end. We bought some stuff last week. We bought a little bit of kind of defensive positioning that we started building our portfolio. We think next year defense is going to be a little bit more of the place to be versus offense. So right now you've got a lot of people piling
okay? You
offense.
mean general defensive stocks? You don't mean the defense industry?
No, yeah, yes, yes. Actually, defensive stocks may actually do okay next year, but
Yeah, but you were talking more broadly than
it's
that.
yeah, more broadly, you have offensive positioning, so gold, silver, technology, discretionary communications. Those are all very high beta risk assets. So next year, those are probably going to come under more pressure, and you'll see a rotation more towards safety and defense. So that'll be things like staples, REITs, utilities. Interest rates come down a bit next year. So that gives a boost to REITs. Utilities do better because of the dividend yield. So you potentially see some kind of that risk off rotation. It doesn't now, does that mean sell all your risk assets and go all in defense? No. What that means is you maintain your risk assets, but hedge that by adding some of these more defensive positionings to your portfolios. That's what we did. So when we're still long Google and Nvidia and gold and silver and platinum, uranium, we still own all that stuff. We're just adding in some of these defensive positionings to the portfolio.
Right. Or you're shifting your mix, right?
Yeah,
It's yeah. Okay.
yeah, exactly.
Um, all right. So you just made a comment there that not everybody would agree with you, but I think I understand why you're making it. So we'll go there, which you said interest rates are going to come down next year,
Mhm.
right? So certainly a percentage of viewers here who don't think that's a given. This is one of the things that, the people that I interview are more, they differ on more than most things. Um, I believe your confidence on that stems from your confidence in that inflation, particularly as measured by CPI, is going to come down next year, and that interest rates are very much a function of inflation expectations. Also, too, you've got the central planners and the administration desperate to get bond yields down. So they're going to be doing some unnatural acts to try to help with this. But my question for you, and you just wrote a new piece about this, I think even today, but will 2026, when the dust has settled, do you think we'll call that the year of disinflation?
Well, we're seeing it now. You saw it. So let's start with the CPI number because that was
Because you're
probably,
going to talk about shelter first and foremost, right?
well, yeah, because that's what drives CPI.
Yeah, yeah. And by the way, I echo you a lot in a lot of my other interviews about this. So yeah,
I mean, there's just there is narrative and then there's freaking math. You know,
yep,
and if you have 42% of anything driven by one number, it's hard to beat. The rest
right.
of it can go crazy, and you're still not going to get a lot of inflation because of what's happening. I mean, you take a look at any rent index, it's going down. And again, so first of all, let's talk about the CPI number that came out. When was that? Wednesday? Thursday? What day did that come out? Anyway, it came out
Oh,
this week.
came out recently.
I know this week has just been so fast. But anyway, in that inflation report, first of all, we didn't get a lot of data. Most of the data was blank, and so there was just a lot of extrapolation, a lot of things that went on.
Right.
All we
But it
know
did
is,
come down, right? 2.7%
yeah,
year over year.
yeah. So we were like 2.9, and it came down to 2.7 between October and November. So, but again, a big function of that is just imputed rents. That's all it is. And there's no evidence right now, anyway. And again, things can change, but there's a massive oversupply of multifamily properties, which is going to keep price pressures on rents.
Yeah.
And
Lance, I think all you need to do with this audience is just say, just listen to Adam's last interview, a couple interviews with
yeah,
Mel Knight. She'll make the comment about why housing is going to continue disinflating
yeah. And again,
or deflating.
yeah.
Yeah,
And
right.
look, I'm not saying I'm not going to say we're going to have a housing crash. I'm not saying that. But there's not a lot of support right now for a re-acceleration of home prices, and specifically, we're talking about rents because of the
Yep.
oversupply of multifamily.
Yep.
So that's
And rents are starting to come down in a large part of the country.
yeah, and so that's very important. The bigger one was in the Fed's latest analysis when they just cut rates. They talked about employment. Employment was negative 20,000 in October, positive 40,000 in November. That's a net 20,000 job increase in 2 months. That is not screaming robust economic growth. So
Right.
slower.
Sorry to interrupt, but the Fed also said they think that the BLS payroll numbers are overinflated by 60,000.
Mhm.
So you subtract that from those numbers and it gets a lot worse even.
Exactly. In fact, this is and so two things about this. One is that, as you start looking at what drives economic growth and what drives, so where does inflation come from? It's supply and demand. That's it. So in the economy, you have to have more demand than you have supply of goods or services to have inflation. If employment is slowing and wages are falling, which are both happening right now to a decent degree, that suggests you're going to have slower rates of economic growth next year, which is going to lead to lower rates of inflation just because of a lack of demand, because prices come from demand.
Hmm.
And you take a look at, for instance, there was a really great chart out. This isn't mine, but there's a really great chart out just this past week. I did not realize this, but it doesn't surprise me. Every single jobs report has been negatively revised this year by a
It
substantial.
doesn't surprise me at
Yeah.
all.
But, which all this, well, which is why all this goes to tell you why inflation has continued to decline this year because of you're reducing this demand within the overall economy. And that was kind of part and parcel of this, analysis that we did on the inflation. We did an analysis on inflation just today, just published it today. But, if you take a look at the annual rate of GDP growth versus the annual rate of change in inflation, not surprisingly, they're very highly correlated.
Yeah.
And that's because inflation is a function of economic activity. And with the extraction of capital out of the market, extraction of liquidity out of the market, extraction of demand out of the market, slower employment, that's all going to contract economic growth next year. And so if the Fed is right and we get back towards 2% economic growth, you're going to have about 2% inflation. Those are going to be fairly closely correlated.
Okay. So what if the administration is right, Lance?
Mhm.
So Trump just got up in front of the nation and said, we're going to see economic growth that America's never seen before. And, you know, him, Besant, you know, everybody involved in the economic team there is saying, look, we've been laying the groundwork. That stuff's really going to start hitting on all cylinders next year. They're even doing some stimulative things like, you know, 17 $1,776 checks to 1.4 million people in the military. We might get those, I don't know the status of kind of the tariff checks that we're going to go to a bunch of houses. Besant saying that people are going to see the biggest tax savings that they've seen in a long time come tax time. Um, just assume for a moment that that actually does all get deployed and work. Um, would you be changing your tune if instead of 2% GDP growth, we had 3.5% GDP
Absolutely.
growth?
Yeah, no, if you start seeing an uptick in economic growth, yes, you're going to get higher rates of inflation because inflation will track economic growth, right? So, but you know, it's interesting. I've been listening to a lot of what they've been saying. We've had tax cuts before. You don't get really a boost. You get a very temporary minor boost in economic activity, maybe a little bit of a bump in inflation, but it goes very, very quickly because yeah, I got a I got a tax refund. I go out and I buy a television with it and it's over, right? You know, if I'm gonna send checks to households, yep, we do that nonsense again. You're gonna get a bump in inflation temporarily because people are gonna run out into the economy, you're gonna spend that money, and then once the money's gone, you know, they're going to go back to where they were. So, you know, all these programs, you know, everybody forgets all these programs, they're all temporary. If you want sustained economic growth and higher rate, and we should all hope, honestly, we should all hope for 3 or 4% inflation. That would be awesome. If we had 3 or 4% inflation in the economy annualized, and you had say 4.5 to 5%, maybe even closer to 5.5% interest rates, and you had wage growth growing at 5.5 and 6% a year to keep up with that,
That's the key thing.
that man, we're cooking. I mean, that's an environment where economic prosperity is just is doing great. That's by the way, that's the 50s and 60s in this economy. We were
Mhm.
growing at 8% annually on growth, and we were killing it. We didn't have any debt back then, which is the big problem. The problem is today we just have too much debt,
Right.
which diverts too much capital into debt service. But yeah, no, that would be great. We should all hope for that. I mean, look, the Fed's hoping that we can just get to 2% and maintain that. If we can maintain 2% growth, we'll do okay. That's not gangbusters though. That's just kind of getting by.
Yeah. Okay. So, you know, look, I think the administration would say, hey, Lance, we've been trying to lay the groundwork for the sustainable stuff. So it's not just gimmicks. It's, you know,
Yeah.
the thousand flowers, a million flowers blooming from deregulation and less, you know, all that stuff, right?
Yeah.
I'm not carrying water for them, but
AI,
I'm just saying, if they manage to pull it off, you're going to change your tune here about, yeah.
absolutely, because no, that's good inflation, right? If we can get good. Look here, I think the biggest upside risk to
Good
inflation.
inflation as long as real growth is positive.
Correct.
We got to be beating it. Yeah.
Exactly. And sending checks to people doesn't create growth, right? Sustainable growth. But what could is if this data center build out takes off as everybody's expected, and we can add 1.5% of economic growth because of productive investment to the economy, building out roads and bridges and electrical power grids and you know, new plumbing lines and all these type of things to maintain and support these data centers, that creates tons of jobs. That increases more wages. That creates more activity in the economy. That's good, productive economic growth. I am all for that. That would be great. Stock markets will be higher. Bond markets will be doing great. I mean, everybody will be happy. Credit will be flowing. It'll be good in that environment. But we've got to get there.
Yeah. So right now you're skeptical. You're not saying it's not going to
Absolutely.
happen, but
I'm
you're
just looking
saying,
at the
yeah.
data, and the data doesn't suggest it yet.
Yeah. But folks, we will be tracking this. So whether the data gets better or worse next year, you know, we'll be keeping you abreast week after week after week here on this.
Absolutely.
All right. So I'm going to start wrapping things up so we can get to the rant. You made a brief comment about trades, but I don't know if those are trades you made actually you already told us about last week, or have you made anything over the past couple of days?
No, no, not that where we
You're locked in for the rest of the year at this
yeah,
point.
last week we talked about our trades adding defense. And so we sold one position for a tax loss, and then we bought some defensive positioning we talked about last week. So yeah, there's nothing for us to do now until after this year is over. We're
Okay.
positioned for year end right now.
From a portfolio management standpoint, I got to imagine RIA is probably pretty damn busy right now, helping clients do all their end of year stuff and
Yeah.
get that done before the end, right?
Our RMDs going like crazy right now. So that's, Roth conversions, RMDs, end of year tax planning, charitable gift donations, donor advised funds. That's been a big one this year. So yeah, that's full bore right now.
Okay, so I know despite all of our admonitions to people and advice to get early on this stuff, if somebody is behind on those things now, but would like some help from you guys, can they still reach out and contact you or?
Absolutely, but you need to get a move on because again, if you just look at the calendar, you're going to have Monday, Tuesday, half of Wednesday, and you're done the rest of that week. Nobody's going to be doing much of anything. And then you're going to have really 2 days, 3 days in January. Sorry, the week after Christmas to finish things up before you hit. And then again, there's going to be so many people gone and on vacation. If you wait till December 31st to call your financial institution, go, oh, I need to do an RMD. Good luck. There's a real risk you may not get it processed.
Well, because even if your advisor's there, even if your guys answer the phone, the guys at Schwab might already be gone, right?
So
Yeah.
yeah, I would. But if you have any year-end stuff to do, A, do your advisor a favor, and B, do yourself a favor. Do it Monday. When you'll see this video on Saturday, but Monday morning, set stuff aside, do your RMDs. If you need to make charitable donations, get that done. I don't know if you've got enough time yet left. I don't think you do to set up a donor advised fund. You can talk to your advisor about it if that's something of interest to you, if you're a high net worth investor. But RMDs and tax loss selling and all that you can get done, and I would do it Monday.
All right. So, folks, if you're in the camp of someone who's behind on this stuff and want to get it done before the end of the year, pause this video right now, literally. Go contact your advisor or go fill out the short form at thoughtfulmoney.com. Connect with one of the ones that Thoughtful Money endorses. Let them know if you want to talk to Lance specifically. But yeah, as Lance said, you're down to the last few seconds on the clock. Get in there now if you can.
Yeah.
All right. So rant. So forgive me if this rant is a little wandering because I'm thinking in real time as we're going to be discussing it. But I want to talk briefly about what happened at Brown University in at Bondi Beach in Australia, tying it back a little bit to the conversation we had, Lance, right after Charlie Kirk was assassinated, because I think they're all connected with sort of the same point I want to make. And that high level point is that we really need to return as a society to uh, dialogue and debate, right? Can be very vigorous, can be uncomfortable, but that's the playing field with which we work out our differences. Um, we've got to really focus on the quality of ideas and not let emotions drive the decision making. Because I think that's one of the big, problems where we are in society right now is we are giving emotions the same weight as ideas and using them for justifications to do things that we really have no business doing so. And I'm sure most people know what I'm talking about here. But uh, this story was personal for me, what happened here, because I went to Brown. So I've got some insights as to the culture on the campus there, or at least the proto culture that sort of became what it is today there. I've even learned that one of the students that was killed at Brown was a classmate of my nephew's in high school. So it hits home on many different fronts. And Lance, since this thing broke out, I've had a lot to say, but I've held my tongue because we didn't have a lot of data, and we still don't. But the morning that you and I are recording this is the morning after they found the body of who the authorities believe to be the gunman who did what happened at Brown. And look, I know the points I want to make here. Uh, I take everything I'm about to say with a big grain of salt as it relates to Brown, because we still don't, there's a lot we don't know still. We don't actually know the motives of the shooter. Um, but when I heard the news of the shooting at Brown, I immediately feared it was somebody who was going to be connected to the university. And the reason for that is, no surprise to most folks who watch the media. Brown is a hotbed of of ideology, of a very specific type of ideology. And again, probably no surprise to too many folks watching this, but having gone there in the early 90s, that was the birth of the politically correct movement, the PC movement. And I saw that happen from day one. And first, I want to say, Brown in many ways is a wonderful place. I'm not trying to tear down the institution. I'm certainly not trying to kick it while it's down and has gone through a very real tragedy here. But what was clear to me in my time there was the politically correct movement, as it had its genesis there, was all about looking at classes that had been dispossessed, right, minority classes, and saying, hey, we need to elevate those people, right? Absolutely nothing wrong with that. Totally get it. But the way in which it was done there, it was very exclusionary. It was in the sense of like, okay, if you're in one of these classes, whether it's based on your ethnicity or your gender or your sexual orientation, that's all in the good. Everything that's sort of in the majority is kind of in the bad. It's kind of the evil. It's the patriarchy. It's the, whatever it was, right? And it was uncomfortable going there as a guy from a majority background. And I'm not looking for anybody to shed any tears for me. And I had made wonderful friends there. It totally opened my eyes to the conditions of a lot of these minority groups and the challenges that they've had to go through. So there's a lot of good that came out of it. But what worried me as I sort of left the campus and matured and got more clear in my thinking, it was very much an othering, right? It was, hey, the establishment is bad. It was sort of a vilification of the establishment, of what we'll call sort of, I don't know, the core culture, say, of this society. And instead of, it could have been, in my opinion, it could have and should have been an and, right? Which is, hey, there's a lot we can learn from these groups and what they've been through. They bring a lot of background and strengths and whatever, and we can add those to the great benefits of our existing society, and we can make kind of everybody better. We can elevate everybody together. And in my opinion, that is based on values, right? What are the values we all agree are the ones that we should pursue together, and then let's support and reward everybody from every stripe and every background towards pursuing those values. Instead, it became much more of an ideology. It became much more of a, well, if you have these attributes, these either physical attributes or belief attributes, then you're good. And if you don't, then you're bad. It became much more of a vilification. And as I said, right after, I mean, just hours after the Brown shooting and what happened at Bondi Beach, was we have to get back to making it about a dialogue about values and about ideas. Because if you don't, if you make it about simply demonizing another group, demonizing an other because they're not in your group, then it provides this false justification for doing inhuman acts. And I think we've gotten to a point in society, Lance, where just like we've created this casino-like market structure where we've taught everybody to be speculators rather than investors, we now have a number of cohorts. I mean, I would say, millennial, Gen Z, Gen Alpha, to a large extent, have been told that if somebody thinks differently than you, then they're an existential threat to you, that words equal violence, and that therefore it's okay, cancel culture-wise, to use violence in response to people that think differently to you. And I think that's just the downward spiral that society is sort of, getting pulled into here right now. So I'll take a beat. There's another point that I want to make on this, but at the end of the day, what I'm trying to say here is look, everybody from every background should have an absolutely equal playing field and be treated equally, be treated with respect. But it should be based upon the values that we all share in common. It should not be based upon some sort of protected status or some sort of, hey, I believe one thing, that guy believes something else, so therefore that guy's bad, and I've got to go after, I'm justified in doing whatever it takes to get rid of that guy. It seems to me that seems to be the theme of what 2025 has really started metastasizing into. That more and more, whether it's Luigi Mangione, shooting a CEO, in the back on a street in broad daylight or whatever, we're in. We're at the danger point of that becoming acceptable in the mainstream. And I feel like this is the point where we as a society need to hold the line and say, no, we can't go there. We got to pull it back. We've got to say it's all about ideas and values. It's not about ideology. So thoughts?
Well, no, I mean, there was a really great article today I was reading. I wrote about this before. I wrote an article called The Dark Side of Technology. There was an article out today called America's Rapidly Growing Happiness Deficit. And it's interesting because they point to all these reasons why people are unhappy, but they don't really get down to the core reason why there's so much loneliness and unhappiness in today's society is because we're all now glued to our phones and our media. And our phones and our media are all designed by the algorithms to feed us whatever information we want, whatever we're watching, right? So it just keeps feeding us more and more stuff. So if I'm already depressed and I'm looking at things that are depressing me, it keeps feeding me more and more of it. And so my point about that is that, you know, when you have the ability, for instance, when the CEO of United Healthcare was shot, there were people cheering on social media about his murder. And when Charlie Kirk was shot, there were people cheering his assassination. What is wrong with you? Right? These are human beings. Whether you agree with them personally or not you know, is irrelevant. These are human beings. And we're cheering their murders or their assassinations because we didn't agree with their ideals. But see, it's okay. You can do that behind behind the screen, right? You won't do that to somebody else's face. I was just having this conversation with a guy yesterday. It's like, we all say this stuff and we'll go onto Twitter and we'll troll people, call them idiots or whatever it is. You won't come say that to my face because I'll punch you in the nose, you know. But this is the society that we've built over there. And if you take a look at depression, increases in depression, increases in and teenage suicides, all those rates started to rapidly increase when the iPhone was released, when Meta went public with Facebook. When those two became public and really became mainstream, we just started seeing depression rates, loneliness rates, unhappiness rates, all those just start to skyrocket. Suicide rates with teenagers, all that's just skyrocketed. And we just keep feeding this stuff into the system. And to your point, nobody's willing to stand up and go, this is not how we act as human beings, right? This is not right. You've got to have some guardrails out there somewhere to keep humans on track. Because if not, they'll become the most depraved individuals on the planet. And we're already seeing that.
Yeah, and as I mentioned, when the news came out that there was a shooting at Brown, again, I was concerned. My immediate gut feel was, I think this might have been a student, and it turned out the guy was a student at Brown. Now he was a student like me. He was. I think he went there in like 2001, right? So he hadn't been there for a long time.
He's a permanent. He was what was it?
Well, he was eventually a
recently.
legal permanent resident, but he was there on a student visa initially. He didn't get his permanent status until 2017.
Right, yeah, yeah.
Um, and look, it seems very clear there's probably a lot of mental issues that went on with this guy. And of course, he after he
Always on.
killed the Brown students, he then went and killed a former classmate of his from his time in Portugal. So this guy clearly had some real issues, and it's unclear. Yeah.
If you're running around shooting people, you have mental issues.
Yeah. But
It's not,
this.
people always act surprised, like, oh, he had mental issues. We should forgive. No, you don't forgive people just because they have mental issues. This is the problem.
Yeah, and I'm not necessarily talking about forgiveness, which is I'm saying it's unclear whether there was an ideology that made him target that specific Brown class. He could go to Brown and target that class. Um, so I don't know, and I don't want to pretend to know, but I will tell you another thing that made me think that a student had done this, or someone familiar with the campus, is that Barris and Hawley, the building that this attack took place in, it's a big science building. And he had to go find this specific class, and that's where he started shooting the students. If you were just going to randomly kill people on a campus, like if your goal was just to just create mayhem, you wouldn't sneak your way into Barris and Hawley and then walk down and find this one particular classroom. I mean, there are plenty of other places on that campus where you could just pick students off in the middle of the main green or whatever like that, right? This was a guy who had some reason that was driving him there. And I don't know if it's just a coincidence or whatever, but the woman that was killed, was the head of the conservative group there on campus. The professor, presumably, even though it's a sciences building and it was an economics class, she was with the Judaic studies. I don't know if it's tied to anything around anti-Semitism or anti-conservatism. The timing, obviously, with the Bondi Beach shooting is highly coincidental, but it might just be a coincidence. There's so much we don't know right now. But my point there is that the 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 culture at Brown is already such a what do I say? Like a high pressure environment around ideology. Very big black and white on who's good and bad. Lots of strong opinions about, how the establishment should be teared down and whatnot. And this guy went there like I did decades ago. I think it's only been turned up even more so since. And so my whole point to yours, Lance, is like if we keep turning up the temperature here and then we worsen it with things like social media and all that stuff, you throw mental, a little bit of mental instability into the mix, things get incredibly volatile. And that's the concern I have about society in general. So let me tie it back here quickly to the Bondi Beach thing. So another completely heartbreaking, terrible tragedy. There was one thing that happened during it, though, that I think we really need to take some learning from, which is you saw that guy, I imagine, Lance, the footage of the guy, just a regular fruit vendor who went and tackled one of the
Yep.
shooters,
Oh,
right?
yeah, grabbed the gun away from him. Good for
Yeah,
him.
I mean,
What a guy.
total hero, no background at all in anything military, just a guy who saw something that was wrong and just, do what he could in the moment. And this is why at the
We should
beginning,
all aspire to be like him.
be like him, Ahmed Al Ahmed, right? So this is why I introduced you as a prudent protector. So you might remember a couple of videos ago, Lance, I talked about how a guy did a deep dive in ChatGPT and a number of the other AI large language models around analyzing the thoughtful money audience. And basically the AIs described the thoughtful money viewer as the prudent protector, a person who was looking out for their family's financial future and very focused on, okay, what can I do to provide for my family and be a good provider and all that type of stuff. And I feel like that's what we need to do if we want to have the type of future that we want to have here in society. It's not enough for us just to answer my call to say, hey, look, put violence aside. We really just got to again embrace discussing our differences and trying to get down to, okay, what values do we all collectively share, and then make sure that we're all driving towards the right values and not choose violence as an option. But we also need to stand up and protect the system we have. And the only way, I'm not a Pollyanna, there are going to be probably way more of these unfortunate events happening in the future than you and I would like, Lance. But what we need to do is not be passive witnesses to it. When we are in those moments and when we see it, we've got to put ourselves in harm's way to do the right thing. And, especially this audience, we're wired to be prudent protectors. And so hopefully nobody watching this video finds themselves in a situation like that. But if we are, I think that's our responsibility, is to step in and do what we can. And I don't think we need to necessarily wait till violence erupts. We were sort of talking about this after the Charlie Kirk assassination. We need to ask ourselves, what can we do in our communities today to be factors that bring down the temperature versus continue to rise the temperature? Where can we help find common ground? Where can we look at, groups that are hurting and likely to turn to violence and interact with them in some way that hopefully bring them closer onto our page in a peaceful way. So that's kind of my clarion call to everybody watching this here, which is, it's time for us protectors to step into our natural roles here. And a lot of us are older in life, and we've lived the majority of our life here. And yeah, if we're putting ourselves a little bit in harm's way, maybe we're the right people to do that. And I'm not encouraging anybody to do something necessarily dangerous, but like, I would hope that if I were in a situation like Bondi Beach, I would follow that Ahmed Al-Ahmed guy, thinking, hey, look, if I get killed during this, at least I'm doing it, standing up for something that I believe in, and I've lived the majority of my life, right? If I can create a tomorrow where those younger than me have a better life to step into, that's a sacrifice that I personally am totally willing to make. So, anyways, I'll leave it at that. But I know you're wired similarly, Lance, so I'm sure you've got something to say about this.
No, I just, this has always been, we've talked about this before, is that, we've all turned our backs on faith and religion. I shouldn't say we all, because that's not true, but, there's a large majority of the population now that have turned their backs on faith and religion and these type of things. And whether or not you agree with religion is irrelevant. What religion is, though, is that it provides a basis of how to behave,
Yeah,
right?
it's a value structure. That's why I'm using the
Right,
term values. Yeah.
exactly. Here's the rules that we live in within society. Don't kill, don't steal, don't covet the neighbor's wife, those type of things. If we could all just remember to live by the Ten Commandments, we wouldn't have these problems, right? But it's always interesting when one of these things show up. We start digging into this person's background and we find out all these things, ideologies that they were taught to or instructed by or indoctrinated by on the internet, or Facebook. They were subscribed to some channel that was just feeding them all this kind of information that drove them to this point. That's my whole point about technology is great. I love technology, but it's also it's also a disease, and it's like gambling, it's like alcohol, it's like anything else. And there are people that are getting addicted to this stuff, and it's warping their outlook on life. And at some point, if you push yourself into a position where you're so depressed, you are so unhappy, you are so lonely because of your world just seems to be collapsing around it, because you see everybody else on the internet living this great life. They've
Right.
all got cars and houses and boats. They all rented that shit for
Right.
their
Or you're so angry because your little social media ideology bubble is telling you these guys are screwing you. Right.
exactly. And it's all them. So it's like, okay, I'm going to go do something about it. That's what we need to really analyze, is how do we create, look, social media is here to stay, and that's fine. Social media can be very beneficial, very useful, but it has to be developed in some manner and wrangled in some manner that it's not a detrimental weapon to certain individuals.
Yeah.
Maybe you've got to start restricting social media till you're 21, right? You can't drink till you're 21 for a reason,
Well,
right?
you heard me make this point. I think it was last week about the Australia ban, or maybe it was 2 weeks ago.
Yeah.
And I got some, I knew I was going to get some blowback from the libertarian stuff, but look, until we've got a better way to do it, I say let's try it and see what happens, right?
What my dad said growing up is that I would do something stupid because I was a kid, right? We all did stupid stuff as kids. And when you were growing up in the 70s, I mean, you did really weird stuff like jump off houses with bed sheets trying to make
Sure.
parachutes. And and my dad would punish me and he'd say, you can't do that again until you can prove that you are mentally able to do that, right? Or physically capable to do that, or mature enough to do that.
Which
And
is unfair because us men, we're like 32 before we're mentally
exactly.
mature. Yeah.
Exactly right. But the premise was there, which is that, you have to have some maturity level to do certain things. You can't drive till you're 16. You can't, drink till you're 21.
All right.
There's a reason for that. Maybe, just maybe, we put in some rules around indoctrinating our kids on social media until they are proven mentally mature enough to be able to make their own decisions properly.
Right, right.
Just
And
saying. Maybe
I,
that's crazy talk,
right.
right?
Well, I don't want to rattle on social media, but also to, again, with the libertarian pushback, which I get. I'm very libertarian minded. But you know, just as we say cigarettes, alcohol, et cetera, are addictive substances, and that's why we don't want kids getting early exposure to them. I think social media very much has a lot of addictive substance qualities to it, right?
Absolutely
Yeah.
does.
So two
By
two
the way,
things.
I got to go because I've got to get on my TikTok now. So
Oh, okay. I know. I can see your hands starting to shake. It's been
I
like,
know it's been an hour, man. Come on.
yeah. But I put not even a post, just a response to a comment on X that's gone pretty viral in the past 24 hours. So it was a tweet from Elon Musk saying, "Hey, we're entering this era of abundance where AI and robotics are going to just create this awesome future for us." And I just responded. I said, "Honest question: what's humans' role going to be in an era of abundance?" And it's amazing what vein that tapped. To me, it was just a throwaway comment. I didn't think anybody was going to see it. And already it's getting close to, I think, like 1,000 people interacting with it. And there is a real worry amongst many, many people that an AI future where everything is done for us, quote unquote, it may not be good for humans.
Right.
Like we need purpose, right? We could, we'll wither, high likelihood we'll wither like the lion, crammed into the small cage at the zoo, right? It's not just social media, I guess is what I'm saying. To your point about technology, there's a lot of what we're sort of hurtling towards that I'm not sure we've really thought through as a society. And I've mentioned that before, and I don't want to rat hole in it, but
Well, just real
yeah,
quick on that conclusion. I've got an article coming up on this because there was another study that just came out on UBI, Universal Basic Incomes. And this was Elon Musk's solution, which is that, oh yeah, well, when we have all this AI automation, we'll just have this government guaranteed income for people. And that way they can go do whatever they want to do. They can become artists and painters and have all this leisure free time. Well, there's been quite a few UBI tests, real-time tests that are either completed or still ongoing, and the results are conclusive across the board as that UBI does not create better economic outcomes for people because they lose purpose.
yeah. To
Great,
me, I
I've
feel
got
like we've
money.
known this forever. I mean,
Exactly.
yeah.
And this is, but this is the fallback position for every politician. Oh, well, if this happens, we'll just do UBI. It's not good for anybody.
It's not going to be, and I don't even think it works economically. I mean, forget about humans' soul nourishment and stuff like that. I mean, I think it doesn't even work economically, but to the much larger point of yours, it creates dependent societies. It diminishes us. And yeah, right now we're just saying, oh, don't worry, that's the solution, right? So,
Yeah.
whole other rant for a whole other time.
Well,
Just to wrap
like
this,
I said, I've got an article coming out on it, so we can talk about it.
okay. When's it going to come out? Like before
I have
Christmas?
to go. I have to go check. I've been writing to get ahead of time because of Christmas vacation, so
Yeah.
it's in the next couple of weeks. I just don't know which day.
Okay, well, we'll keep our eye for it. And if you want to talk about it here in a rant after it comes out, we're more than willing to. But just to your point here, again, it's all about value systems and whether it's religion. And I'm glad to see that more and more of the younger generations are turning back to religion. Not because I am an organized religion guy myself, but to your point, Lance, it shows that they are realizing that what is being offered to them is devoid of purpose, and they're seeking that out, right?
Right.
So whether it's a community organization, whether it's a church, whatever, I just think that's a good thing, right? As long as they are finding their ways to structures that give them values that are consistent with the ones that have made Western society great. Um, and I didn't just want to sit here and bitch about problems. So I was trying to think like, so what values really matter to me, right? And I didn't really have much time before we hopped on here. Like I said, I'm thinking about this in real time. But a few that just came to mind are like, look, respect for others and kindness as the default, but kind of like Patrick Swayze in the movie Roadhouse, like be nice until it's time not to be nice, right? Don't just become a doormat to get taken advantage of. If somebody's doing something they shouldn't do, like the Bondi Beach guy, you step in and you put a stop to it. Accountability, personal responsibility, hard work, community investment. Your default should be to build up, not tear down. I'm sure there's a whole bunch of other shared values out there that folks watching this can add and create a much better list than I've started here. And folks, if you have them, just start mentioning them here in the comment section below. I'd actually love to compile something that I could put out there. But if we can agree on what our guiding values are, then everything else is just tactics, right? And my last parting call for folks on this very long rambling rant is, ask yourselves, once you've got your list of values, how can I be living those better, both in terms of just my actions in the world, but how can I serve as a beacon or an inspiration for others around me, whether they know me well or don't know me at all, to look at me and say, hey, that's a guy that's doing stuff that I want to be doing too, from a value standpoint.
Absolutely true. And there's a great book for that. I reread this book probably every couple of years because it's basically the premier tome of how to live a better, happier, more prosperous life. And so you should all
What's
go
it
get a
called?
copy of it. It's called the Bible.
Oh, okay.
Everything you just said is in the Bible if you just read it.
All
How to
right.
live
Well, look,
a better life, how to treat others, how to become prosperous, how to live a life of wealth and prosperity and happiness. It's all in the Bible. You just have to read it.
okay. And I think that's a great place to go. I'm not here pushing any particular
No, no,
religion,
no.
folks.
I'm just saying,
I,
whether you're religious or not, just read the book, right? That's all I'm saying. Just read the book as a book. That's it. It's story. So everybody loves a good story. The whole book's just a big story. Forget the religion part, right? Forget the all that. Just read it like a book. Enjoy the read. There's great adventures. There's people that are having battles and wars, and there's people falling in love and having babies and having all these trials and tribulations. It's just a great read. But in it, you learn lessons about how to live a more prosperous, happy, loving life, how to treat your spouse, how to treat others. Do unto others as you'll have them do unto you. You know, that's it. It's just a good read. That's
all
why I
right.
read it every couple of years.
Well, that's a great segue to my next and last point here, Lance, which is Merry Christmas, buddy. I'm wishing you all the best. We are, well, actually, no. So Merry Christmas to you, Lance. Happy Hanukkah to your co-portfolio manager, Mike Leibowitz. To everybody else watching, same to all of you. And if you have a different religion or no religion at all, I'm just going to wish you happy holidays. But yeah, so next week we will be doing a weekly market recap. It's going to be with Mike because Lance, well, you're going to be off enjoying your Christmas holiday,
You're
and then
celebrating.
you'll be on the following week. So we're not going to skip a beat here, folks. We're going to keep giving you your weekly market recaps, even though we're in the depths of the winter holiday here. But again, I hope you and your family have a great time, Lance.
It's actually so I'm taking my wife to Beaver Creek for a couple of days just to get her out of Houston. We're coming up on our final chemo treatment, but it's thanks to all the prayers that I received from all of your listeners. I mean, everybody that watches this, I've received literally 2,000, maybe more,
That's fantastic.
warm wishes, prayers, thoughts, all these type of things from my wife. And my wife just had a blood test. And there's a blood test called quote me, I may be wrong on this pronouncement. It's like a Singulara test. It's a blood test, and it tests for cancer in the blood system. And the test came back no evidence of disease, which
What?
is, yeah,
She's
absolutely.
not even done with her treatment yet.
Not even know the treatment. We got one more treat. Our next treatment is the following Friday, January 2nd, is our final treatment. But no, so when we got that blood test back, I booked her a trip to go to Beaver Creek. She has a favorite little hotel there that she likes, and go get a spa day, that type of thing. Enjoy some snow, for Christmas. So yeah, but it was all the prayers. I mean, all the prayers and things that your listeners did were a big help in getting us to where we are right now.
Well, that is just the best news ever. I don't want to get ahead of things. I'm going to
Well,
call this a Christmas miracle, but yeah, don't want to jinx
it,
anything yet.
it does not mean she's cancer free. It just means that right now there's no evidence of disease in her blood system, which is a very good sign.
That is fantastic. Okay, and so she has one chemo treatment left, right, in 2 weeks or so, right? And you'll take her to that. And then hopefully she just gets to rest and recuperate, get her strength back, and then maybe
Yeah.
get
Yeah.
the permanent results that we're all hoping for.
Well, so after the next chemo treatment, we go to 3-month visits for 5 years. And if we go 5 years without recurrence of disease, she will technically be in remission. And the most important thing is she'll be able to grow her hair back.
I'm sure, I'm sure to her that's big on the list. All right. Well, look, my friend, that is just the best news ever. I hate to make this so pedestrian, but folks, if you want to show Lance how happy you are about that, please do so by hitting the like button. I'm sorry to make that the tie-in.
That's all great. We got to wrap it
Uh,
up.
But that is fantastic, folks. Also, just share your comments with Lance about how wonderful that is. Okay, and if you would like, as I said earlier, look, if you're behind on your end of year tasks, talk to your financial advisor right away, or reach out to one of the financial advisors that Thoughtful Money endorses, maybe even Lance and his team there at RIA. You can do that by just filling out the very short form at thoughtfulmoney.com. Even if you're up on your end of your to-dos, but you want to plan for 2026 and you're looking for professional help in that as well, you can fill out that same form. Just a reminder for folks, if you have not yet taken Andy Schechtman up on his offer of buying junk silver right now, which just hit another all-time high as we've been talking, Lance. I've been checking the futures price. And I'm going to use your term. It's now 6-7, right? But
Nobody
folks,
knows what that means, by the way.
nobody knows. I mean, even the Gen Alphas that came up with it don't know what it means, right? But yeah, sorry, folks, if you don't know the meme, you're good. I'm not going to explain it to you because you're better off not knowing. But anyways, if you would like to take Andy up on that offer of buying junk silver for $1 under spot, you can still do so while supplies last by going to thoughtfulmoney.com/buy gold. Fill out the very short form there, and Andy's team will be out in touch with you real quick. All right there, Lance. I'm going to let you have the last word.
Merry Christmas. Many blessings to you and your families. I hope you all have a wonderful Christmas holiday. And, again, the New Year's, we're all hoping for a happy and prosperous New Year for you as well. So, yeah, see you. I will miss y'all next week, but I'll definitely see you the following.
All right. I can't say anything better than that. Thanks, buddy.
Yep.
Everybody else, thanks so much for watching.
Clearly in Asia, particularly in China, they view it as money. And of course the BRICS, and that's one of my biggest bullish factors for gold, is I saw the de-dollarization and countries moving away from the United States economically and from their currency as bullish for gold. So that would argue that I still think it has to go a lot higher over time. But I think a reasonable target of 4,000, I think it's been accumulated. It's still probably 12 to 24 months away before they officially come out and say, okay, this is how we're going to trade among ourselves. And part of that is going to be gold. People who are going to talk about, the Hunt brothers and once went to 50, well, to get back to that, you're right. It's almost going to have to trade at 200 for inflation. So what I have said, and it probably throws me into the silver bug camps completely, is that triple digit price of silver is a legitimate target.
In Asia, especially China, gold is still seen as real money, and that perspective is spreading among BRICS nations as they move away from reliance on the US dollar, a trend that strongly supports higher gold prices. China's central bank continues buying gold. In August 2025, it purchased about 2 tons. BRICS nations are developing alternatives to dollar-based financial infrastructure, including digital payment systems and local currency trade. Gold is increasingly seen as a neutral reserve asset among these countries. Given these shifts, a long-term target of $4,000 for gold looks reasonable. Silver also has enormous potential. Adjusted for inflation, its 1980 peak near $50 would be closer to $200 today, making triple-digit silver a realistic and justified goal. Peter Grandich, a veteran market analyst and financial commentator, recalls that back in the 1970s and early 80s, few believed the Dow could ever reach 3,600, let alone 36,000, but history proved otherwise, just as today many doubt gold's ability to climb much higher. The reality is that fundamentals for gold have never been stronger. De-dollarization is accelerating across Asia and the global south, with central banks and retail investors boosting gold purchases and trade in local currencies rising. BRICS nations are building alternatives to dollar-based systems, and gold is increasingly viewed as a neutral reserve asset. China continues steady gold accumulation, though its reserves remain low compared to its economic size, leaving room for much more buying. Analysts expect this sustained demand to lift gold's floor higher, with BRICS discussions of gold-linked trade further supporting long-term price growth. BRICS nations are exploring dollar-free trade, with gold discussed as a potential benchmark or backing asset, though no unified gold-backed currency exists yet. Rising central bank demand, especially in Asia, is lifting gold's price floor, while silver also shows huge upside, with inflation-adjusted targets pointing to triple digits. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the article. We value your opinions.
For 13 years, the Dow only traded between 700 and 1,000. In fact, the very famous Business Week front page said equities are dead. Wall Street was extremely bearish. And an unknown young man came out of Gainesville, Georgia, named Robert Prec Jr. with a philosophy and a technical analysis no one really knew of, Elliott wave theory, and said the Dow's going to 3,600. And they just prosecuted him to call him every name in the book. And then when the market took off, he became popular, and then he made a call about the crash in 87 along with me. And the perception was, how could it possibly go to 3,600, let alone a few decades later, 36,000 and more? So that same feeling's in gold right now. People, especially people that have been bullish and profiting from it, this 36, this is way out of line. Yeah, it's great. It give you all the reason, but how could it go a lot higher? It's not possible. You have to take that same philosophy. There's no reason it can't. In fact, I would argue it's not cheap anymore. Someone that was buying it at 1,300, seeing the tripling. But the fundamental argument for gold has never been better. We had at one time suppression by central banks who were offloading it. Now they're the biggest buyers. We had clearly not any society thinking it was money. Clearly in Asia, particularly in China, they view it as money. And of course the BRICS, and that's one of my biggest bullish factors for gold, is I saw the de-dollarization and countries moving away from the United States economically and from their currency as bullish for gold. So I think the more important way to answer your question is not talk about some of the general stuff or inflation or even against the stock market, is to admire how it's performed in an environment wasn't as conducive as it is now. So that would argue that I still think it has to go a lot higher over time, but I think a reasonable target of 4,000. And remember, when you're in all-time highs, other than a psychological number, there's no real resistance. So, pick 4,000. Yeah, that'll be a round number and so forth. And, Wall Street has treated gold like kryptonite. I think 0.5% of portfolios are assumed to have some exposure to gold. Can you imagine if people just went to 1 or 2%? It's still a very, very viable market for the long term. Well, I think it's going to play a significant role in the BRICS. They have not acquired all of this gold as a trade or a personal investment. They certainly can't flip it to someone that's going to pay even more so they profit from it. I think it's been accumulated. It's still probably 12 to 24 months away before they officially come out and say, okay, this is how we're going to trade among ourselves. And part of that is going to be gold. I don't think there's a worldwide situation coming anytime soon, because I think things have to get a lot worse before people realize how messed up we been with fiat currencies. I do still think that one of the ways that they're only going to be able to sell treasury bonds, especially long dated ones, a year from now, because I'm a big believer that short rates can fall, but long rates are only going to go higher. I think that's going to find a way that the Trump administration could reprice its gold that it owns to whatever the current price is, and also introduce longer term 40 or 50-year bonds with some sort of gold backing in order to get people to buy it. I think that's going to be how difficult it's going to come for the United States to fund itself, while other world bond markets, as we speak, are imploding as well. 180, and it was profitable to treat it as the second-class citizen to gold. But earlier this year, when it dipped under 30, when I looked at the fundamental argument, it was never stronger in the 41 years I've been involved. So I became a silver bug. And I also said it probably would lead gold for quite some time to come. And I think that's happening here. I think you make an excellent observation. People who are going to talk about, the Hunt brothers and once went to 50, well, to get back to that, you're right. It's almost going to have to trade at 200 for inflation. So what I have said, and it probably throws me into the silver bug camps completely, is that triple digit price of silver is a legitimate target. First of all, it's not that much more than a double from here. It sounds like a lot because for a lot of years it was single digits, low price. But I think it has every reason to continue to rise with gold. And the competition for it, the stock market, I have to throw this in. I made a big change a couple of weeks ago. I was not in the stock market crash camp. My January forecast for our clients was the stock market was going to be either side of unchanged. I told people to avoid U.S. equities, get into world funds. I love the Chinese market. But a couple of weeks ago, stuff just screamed that we were very vulnerable to a hard fall or even a crash. And that has been competition to gold and silver and also cryptocurrencies. And so a lessening of the bull move or an actual decline, as long as it's not a total crash, could only aim the gold and silver. You know how I know that, Jesse? I left the metals and mining industry as a main place of business for myself in 2013. I dipped myself back in 5 years ago when I got very aggressive in gold and mining stocks and all. But I'm hearing from people in the last few weeks that I haven't heard from 10 or 20 years and saying, hey, I was looking up metals and I saw your name. I thought you left the business. And then, of course, the follow-up question is all the same. So what do you like? And I think we're just at that stage now where, other than that little audience that always confined ourselves to, we used to call ourselves the hard asset crowd. I don't think we say that anymore. It's being broadened out to generalists. And I think that's going to bode to help the metal prices higher.
Peter mentions that the mainstream U.S. financial media won't highlight gold and silver because of their ties to Wall Street. But once public demand grows, that will change. Major gold producers are already generating huge cash flow and could see much more interest as generalist investors notice their outperformance. The largest gold miners reported record free cash flows, revenues, and profits in Q2 2025. Margins are very strong. However, production has fallen for some majors. Juniors are expected to outperform seniors in this cycle due to high leverage and exposure in exploration and resource discovery. Established miners are expected to continue reporting strong cash flows, using capital for dividends, buybacks, and to shore up balance sheets. Despite strong gold price performance, analysts, including Peter, believe gold stocks are lagging and undervalued relative to gold itself. Analysts are watching for better leverage to gold, and many see additional upside as investor attention and valuations catch up. Let's dive into the interview.
Well, much of the mainstream financial media in the U.S. is tied to the hips of the financial service community. They're not going to write things go against it. They're advertisers, So I never expect them to write glowing stories about that, because gold and silver have been treated like kryptonite since I've been in the business by the financial service industry. And I don't expect that to change until the public overrides that demand and says, hey, listen, I'm listening, or I got this neighbor and they're killing it, and blah, yada, 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 yada. And so that's when I think the public will come to it. The mining stocks, even the exploration, and they're two different species, and I'll address them both. The mining stocks, as I said earlier, when I originally sold some of my physical gold in the beginning of the year at 3,500 to buy the major gold producers, which greatly outperformed the performance of the physical gold, they have many quarters ahead of just unbelievable, legitimate printing money through free cash flow. And what will happen for them and what will keep that sustained for them is, as we peter out in the stock market here, and we're seeing a lot of companies now not meeting the low-end earnings estimates so they can always say they beat them, these generalist money managers are going to hear about these mining companies. Look at Newmont Mining. Maybe today, as you and I record, depending on if Palantir gets hit enough and Newmont is rising, it's going to be the best performing stock in the S&P 500. Right now, it's number 2. And so that means it's outperforming 498 other general equity stocks. And yet, I would tell you that if we looked at people's portfolio, not half of 1% have Newmont Mining in it. So there's still so much upside demand for mining shares, and they should do well. But where I went to, and it's the most riskiest and speculative end of it, and remember, Wall Street created the word speculating, so don't really call it what it really is, and that's gambling, where you have to be mentally and financially prepared to lose part of all your capital. But the juniors is really where we're going to see a really bang for the buck. We're already seeing that in some incidents. And the reason is the world has not only shrunk to where companies can go and without too much risk and try to find the metals that are so critically needed now, everybody realizes, but the amount of money that has not gone into that industry to find these things. And remember, even if you hit it tomorrow, that you just went to a rock and drilled and it doesn't work that way, it takes several years of exploration and all. It's probably anywhere minimum, depending where in the world, 10 to 15 years before it comes out and pours the first metal and all. So when that recognition is realized by everybody and everybody realizes how we're scrambling, a gentleman made a good point to me the other day, and it was Sam Lee, it's actually the largest stock that I own, North Isle Copper and Gold. And he was just on a trade mission for Canada to South Korea and Japan. And he made a very good point is, even though they're world renowned for producing so much of the stuff we need, technology stuff, appliances and all of that, their entire base of metals that they need is from outside their country. They don't have any real own supply of their own. So here we have the world is scrambling for critical minerals and all. There's not been a lot of money put in them. I think that's going to make exploration companies become darlings for a period of time. And the majors, their currency is so strong now because of their stock, they're not going to try organic growth. They're just going to go out and buy because we're still seeing good deposits selling for as little as $20 an ounce with gold at 3,600 and going higher. So to answer your question, I'm sorry for being long-winded, but I just think the mining shares and the exploration stocks, their day in the sun to where everybody's seeing it hasn't even arrived yet.
Metals and miners are poised for a solid next run higher, with fundamentals stronger than ever. Will the formalization of a gold-linked trade system by BRICS eventually hasten the move away from the US dollar? Is it possible that cheap mining stocks may eventually overtake gold's performance and produce disproportionate returns in the upcoming cycle? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
What percentage of gold backing the rest of the Fed's balance sheet would make the rest of the treasuries trustworthy to hold for people. And if we go to the 1980 numbers, it's something like $40,000 to $50,000. If we are to equate the dollar value of those 235 million ounces to the rest of the pile on the balance sheet, which is the monetary base, it would have to be 30 to, I think it's about 50,000, or it could be 55,000, somewhere around there, like between 40 and 50 or something like that. It doesn't really make a difference. But that's what we're talking about. I'm not talking about covering M2. I don't think we're going to get there because to cover M2 is what, like 21 trillion, whereas the monetary base is like 5.6 trillion. It had to be 4 times that. I don't think we're going to see $200,000 gold. I think the dollar's going to break before that.
In 1980, the market drove gold higher because investors no longer trusted the Fed's debt-heavy balance sheet. Gold rose enough to fully back that debt, restoring confidence. Applying the same logic today, with the Fed holding about 235 million ounces of gold against a $5.6 trillion monetary base, gold would need to reach roughly $40,000 to $50,000 an ounce. Covering the broader money supply would imply $200,000 gold. Rafi doubts it will reach that point, expecting the dollar to collapse first. Rafi Farber is a financial writer, investor, and commentator often referred to as the endgame investor. He explains that gold is real money, and when its price changes, it's not gold being revalued, it's the dollar. History shows 2 forms of revaluation: statutory, like in 1933 when FDR raised gold's price from $21 to $35, fueling inflation, and market-driven, like in 1980 when distrust in the Fed's balance sheet drove gold up to around $850. Both have the same effect, shifting the value of the dollar, just through different forces. A recent Federal Reserve analysis into gold revaluation mirrors a broader concern over the dollar's stability. While not signaling immediate policy action, it underscores the extent of fiscal stress. These discussions signal deeper doubts about the sustainability of fiat frameworks. Today, stresses in the dollar system are showing up again in the gold futures market, where spreads across maturities resemble those seen in the 2008 and 2020 crises. This suggests another monetary breakdown may be near. While the timeline is uncertain, the underlying truth remains: gold is money, and its role as the ultimate measure of value won't change no matter how the dollar performs. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
What it means that gold is the money. If the gold is the money, then every time the price of gold moves, it's revaluing the dollar. Gold doesn't actually get revalued. The dollar is being revalued. Now, the question is, are we talking about statutory revaluation or market-based revaluation? You just cited two examples, one being 1933, which was statutory, right? FDR just decided, maybe on some advisement, maybe on a whim. I remember I read when I was turning libertarian when I was younger, but he was talking about, I think in his book, Broke, how FDR just decided on a whim to make it 35. I don't know, he was just like flipping numbers in his head and he decided that was the one. Could be true, I don't know. And then you were talking about the revaluation in 1980, where the price of gold in the market that you could get a gold coin for to shop was what was being revalued, and that hit 872 or 850, wherever you want to count the top. And ultimately, these are really the same thing. Right? They're brought about in different ways, and that's but they are. Monetarily speaking, what is happening in the monetary system, it's the same thing. It just the difference is who's acting upon it. Like if a 50 kilogram weight drops on your head, you're not going to really care that much if it was, like, say, a meteor from God, or let's say somebody had sinister would drop something on your head from 100 feet above you, or drop the piano on you. Either way, you're dead. It doesn't make a difference. So I don't think we're going to have a statutory gold revaluation. And what happens during a statutory gold revaluation? Well, you look at the price inflation statistics, which we have from the 1930s. And in April 1933, I think the deflationary, and I'm talking about consumer prices, the deflationary statistics were something like -9% a year. And then by about 10 to 12 months after the revaluation from 21 to 35, price inflation shot up to positive 10, 15% or something like that, like a huge move. And really that was the point, because by revaluing, that gave FDR's government, or the Fed under him or beside him or whatever, the ability to print more money based on that gold revaluation, and then the inflation came from there. If there are problems with the dollar, then what you would see is spot gold going pretty high relative to other maturities, but going out into the future I think you would compress in the middle, and then the price would go higher out into the future, because you'd have speculators that are also worried about the dollar, because they're using gold to speculate because they see something wrong with the dollar. But also you have the people at the mouth of the pipe, the big banks, and they are going after spot gold itself. So you're having these like kind of zigzaggy, wavy maturity scheme. And I think that's what's happening now. But you'd have to look at a chart of this. It's available on Gold Charts or Us to see all the maturities and the different colors of the lines, and they get wider as we get closer to a crisis. So the chart goes back to, I think, 2005, 2006. The only time I've seen the maturities be this spread out are 2008, 2020, and now. So the question is it happening again? And there are other signs that corroborate it. How far out are we? I don't think we're very far. People say, like, I've been around since 2020 saying the same stuff, but it's 2025. Even 5 years is not that much time. I know that's kind of a cop-out, but it's also true, and gold is still money. I mean, it doesn't really matter, because I know what the truth is. People can say what they want, but the reality is reality. It's not going to change.
Rafi thinks that the financial system is like a giant pyramid with gold at the base and countless layers of debt and derivatives stacked on top. Nothing can replace this structure. According to BIS, proposals like the stablecoins can boost liquidity and payment efficiency, but they don't fix the financial system's core weaknesses. They only add another fragile layer. Their heavy reliance on U.S. Treasuries exposes markets to volatility, where sudden redemptions could spark liquidity shocks. Even with new rules like the Genius Act, critics argue regulation creates only an illusion of safety while deeper risks remain. Eventually, a crisis will force people holding stablecoins to convert them back into cash, triggering a rush for dollars. At that point, the Fed will have to step in and monetize debt as always, because the underlying pyramid hasn't gone away. These measures may provide short-term liquidity, but in reality, they make the structure even weaker, like stacking jello on top of bricks. One small shock, and the whole thing risks collapse. Now, let's review the interview.
No, it's not going to replace anything. All it's got, we're on a pyramid. The pyramid begins with gold, goes up derivative layer by derivative layer to where we are now. And there's a lot of derivative layers, and you can argue about what layer is which layer and where is it in the pyramid and all this stuff, and it's very complex. But there's no getting out of this pyramid without it either falling over or building a new layer that looks new, but it's really based on everything that's on before. Right? All you can do is build one more layer. So if they do this Genius Act and stable coins, and obviously there are serious threats to personal liberty involved with stable coins, fine. I don't dispute that at all. And I know that the government wants to take as much liberty as they can from us, reasonably, as much as they can reasonably get away with. They tried taking away almost all of it in COVID. There was backlash, and Trump got reelected. I'm really oversimplifying, I know, but I don't have time to get into geopolitics here or anything like that. But what the Stable Coin Act or the Genius Act, whatever they're calling it, can do is it can turn T-bills into a more liquid asset by making them tradable. If people are going to take stable coins as settlement for payment, then it turns T-bills into basically dollars. So the Fed wouldn't have to monetize that debt as quickly, theoretically. But sooner or later there's going to be a crisis anyway, and then everyone with stable coins is going to they're going to need cash, so they're going to have to sell out of their stable coins to get dollars, and there's going to be a rush on dollars, and then Fed's going to have to monetize it anyway because all of this pyramid is still there, and all prices from today are still based on yesterday. No matter what the hell you do, there's no getting out of that ever. Just like there's no breaking the law of gravity, you cannot fly without counteracting gravity with an opposite force pushing down. It's not possible. So at that time when suddenly there's a dollar crunch and everyone has to get out of their stable coins to pay their bills, right? Then the Fed's going to have to take those T-bills, turn them into dollars by buying the T-bills, giving dollars to whoever needs to give dollars to whoever has the stable coins. We're going to be in the same place we are now. So the most this can do is provide a little bit more liquidity on the top of the pyramid. But I guess an analogy would be like instead of like a really heavy brick on the top, right, on the top layer, you'd put, let's say, I don't know, something a little more jiggly, maybe like Jello on the top. So you can build it higher, but it's like a lot weaker, and like a little bit of sun can melt it, and then it just falls over anyway. That's the analogy that just came to my head. Jello.
History shows that whenever trust in the dollar erodes, gold steps in as the ultimate anchor of value. Whether through statutory moves like FDR's revaluation or market-driven surges like in 1980, the effect is the same. The dollar weakens, and gold reasserts its role as real money. Today's fragile financial pyramid, propped up by layers of debt and experiments like stablecoins, cannot escape this reality. As stresses build and liquidity games run their course, gold remains the foundation that cannot be replaced, only rediscovered when confidence in paper assets fades. If gold does climb toward $40,000 an ounce, how might this reshape global financial markets and investor behavior? Could stablecoins and digital assets delay a monetary crisis, or do they simply make the eventual collapse sharper? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey.
in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. To be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me.
Central bank and sovereign demand for silver is rising, supporting higher prices, while COMEX and LBMA delivery activity and ETF redemptions indicate big players are taking physical possession. Analysts view silver as undervalued versus gold and expect a breakout, targeting $60 to $70 by year-end, with potential $100 to $200 plus in a full monetary or credit stress scenario. Risks include unverified accumulation data and uncertain timing of delivery squeezes. Michael Oliver, CEO and founder of Momentum Structural Analysis, argues that measuring silver in dollar terms is almost meaningless. He sees silver potentially reaching $100 to $200 but takes it in stages, personally favoring silver miners over gold. Historically, silver has averaged around 2% of gold's price and even hit 3 to 3.5% in past bull markets, while today it sits at just 1.12%. With silver already up 42% this year versus gold's 37%, technical charts suggest an imminent breakout. Several well-known bullion commentators and dealers' voices like Andy, Bill Holter and Mike Maloney argue the market is now driven by huge physical demand, tightening supply and central bank sovereign buying, conditions that can push silver rapidly higher and make a $60 to $70 year-end print plausible. They point to record COMEX delivery interest, growing central bank interest in silver, and China's physical buying as the catalyst for an imminent breakout. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think it's really irrelevant. As I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it. We have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, The spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, oh boy, you break through that and I'm going to blow the cork off this thing. The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Michael Oliver warns that relying too much on fundamentals can mislead investors about timing, like the analysts in The Big Short who were early but not immediately proven right. In 2025, silver has risen 45% so far, hitting about $42 by mid-September. Rising industrial demand for EVs and solar panels, continuous supply shortages of about 800 million ounces since 2021, and growing central bank and investor accumulation through physical holdings and ETFs are the main drivers of its climb. Although supply is static and demand is dominated by China, silver's industrial role is expanding. Nevertheless, until prices compel attention, markets frequently overlook such truths. More significantly, silver has historically been used in conjunction with gold as money. Confidence will crumble as inflation reduces purchasing power and people lose faith in institutions, currencies, and central banks. This transition from optimism to anxiety could be brought on by a declining stock market. Major systemic changes, like the Federal Reserve's demise or income tax reform, are made possible under that setting. That unrest will help silver as an industrial metal and as currency. Let's shift our attention towards the interview.
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? You know,
Yep.
Do you remember the movie The Big Short?
Yep.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table. Okay. That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point. Fundamentals. Mm-hmm. Okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. Annual production of silver is not increasing. It's plateaued and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it. Okay. And that's a good excuse. Oh, well, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows, it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid, it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up, because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
As trust in fiat currencies and institutions declines, there is a chance for sharp movements. How much higher may silver's price realistically rise in the upcoming years if it even recovers to 2 to 3% of gold's value? Will a decline in trust in central banks hasten the adoption of silver as a monetary asset and an industrial necessity? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.